You are listening to The Vocal Technologist. Spoken tech for your ears.
In the first few days of June, like $1.5 billion completely evaporated from the crypto markets. And, here's the crazy part.
It wasn't a hack.
Right. It wasn't a hack. It wasn't because the long-term, die-hard believers suddenly woke up and sold off their holdings. They didn't touch a dime. The crash was entirely driven by the hyperactive 40% of the market, just basically panicking over macroeconomic data.
Yeah, the surface water is incredibly choppy right now. I mean, if you just look at the headlines, you're seeing AI tokens crashing, Bitcoin dipping below 63,000, and just widespread panic.
Exactly.
But beneath that surface noise, there is this massive silent restructuring of the global banking system happening right under our feet.
Which is exactly why we are taking you on this deep dive today. We have a massive stack of mid-2026 financial and tech newsletters to go through.
And we're covering a lot of ground.
Yeah, everything from market flow data and sector survival analysis to some very aggressive kind of under-the-radar moves from legacy banking giants.
Right.
So our mission today is to help you separate the daily market distractions from the actual utility being built. By the time we finish, you are going to have a really clear map of where global money is actually moving.
And to map that out, we really have to start by understanding the brutal reality of the current market environment. The macro picture right now is what the sources are calling the H2 2026 survival filter.
The survival filter, I like that.
Yeah, because capital has become completely ruthless. We are no longer in an environment where people are blindly accumulating on the dips,
Well, I am looking at a Binance research chart in our sources, though, and it says 60% of all Bitcoin hasn't moved in over a year.
Right.
So if the vast majority of the supply is frozen solid and no one is selling, how are we seeing billions of dollars in liquidations? I mean, the math just isn't mapping for me.
It seems contradictory, sure, but it is actually a textbook low liquidity environment. You have to think of that 60% as the bedrock. Those are wallets that haven't transacted in like 155 days or more. Because that bedrock is completely frozen, the remaining 40% of the supply entirely dictates the price action.
Ah, got it.
And that active 40% is highly leveraged.
Meaning they are trading with borrowed money.
Exactly. When you trade with leverage and guess wrong on the price direction, the exchange automatically sells your assets to cover the loan.
Which is a forced liquidation.
Right. A leveraged long liquidation. And right now, that 40% is just hypersensitive to things like U.S. inflation data or European central bank rate decisions. The minute the macro picture looks slightly gloomy, they dump their assets.
So in early June, that active group dumped $2.4 billion into the market.
Yes, which triggered a violent cascading $1.5 billion in those forced liquidations.
Okay, that explains the spot market violence.
Yeah.
But even the traditional finance products took a massive hit, right? Like the sources note a 13-day consecutive outflow streak from the spot ETFs.
Yeah, totaling over $4.3 billion. Which analysts at Presto Research point out is the largest sustained withdrawal since those products launched in early 2025. Institutional sentiment is firmly risk-off right now.
They aren't messing around.
No, capital is no longer buying into a narrative just because it sounds exciting. The market demands measurable usage and actual token value accrual.
Well, speaking of narrative, I have to bring up this detail about Arthur Hayes from the sources because it just blew my mind.
Oh, the WorldCoin trade?
Yes. He liquidated his entire position in WorldCoin, the WLD token, in under 24 hours. But he didn't do it because of anything happening with WorldCoin itself.
Right, he was using it as a liquid proxy trade.
So unpack that for us. How does a random crypto token act as a proxy for SpaceX, which is a private aerospace company?
It comes down to narrative correlation and market liquidity. So Sam Altman is heavily associated with WorldCoin.
Right.
And obviously, he is a primary face of the AI boom. Investors often group these frontier tech narratives together. AI, space exploration, advanced cryptography.
Just lump them all into one bucket.
Exactly. Since SpaceX is a private company, you can't just log on to a brokerage app and short its stock easily. So WorldCoin became a highly liquid, immediate way for massive traders to bet on or against that broader frontier tech sentiment.
So when Hayes saw pre-listing quotes for SpaceX on a platform called Hyperliquid drop by like more than 50% ahead of a NASDAQ debut, he realized the appetite for that whole sector was collapsing.
Right. He didn't wait around for WorldCoin to react. He just dumped it immediately to protect his capital.
Man, That is the ultimate example of that survival filter in action.
Completely. The days of buying a story are over. If a token or a project don't have intrinsic measurable utility right now, the market is heavily penalizing it.
So the market is punishing pure narrative. Let's put the biggest narrative of the decade under the microscope: AI intersecting with crypto.
Oh, yeah.
If usage is king, how is the AI sector actually holding up?
Well, it is entirely split. In the first quarter of 2026, AI tokens that had zero actual usage completely collapsed,
Like how bad?
dropping 80 to 90%.
Ouch.
But the broader AI crypto sector actually grew from roughly $9 billion in early 2025 to over $22 billion by May 2026.
Wait, that is a massive divergence. Who actually survived that purge?
The infrastructure layers. Projects with quantifiable on-chain activity. A great example is DePIN now, which stands for Decentralized Physical Infrastructure Networks.
Okay, so what are those doing?
These are networks crowdsourcing physical compute power and data storage for AI models. Because they act as the picks and shovels layer and offer a tangible service that developers are actively paying for, they actually posted a 25% gain.
Right, because you can measure it. It's not just a white paper promising the future. It's real compute power happening today. But the sources also throw some cold water on this whole intersection.
Yeah, they do.
There is a new research survey that points out a major flaw in how we think about decentralized AI pipelines.
Yes, the survey found very little public quantitative evidence that decentralized AI pipelines are actually cheaper or more efficient than centralized ones yet.
And worse, it highlighted a severe structural risk: AI autonomous trading agents colluding.
Which is terrifying.
Yeah. If you have thousands of opaque bots executing trades at lightning speed, they can essentially create market abuse vectors that completely box out human retail traders.
Which is a very real concern when these systems are operating faster than any human regulator can track.
Yeah, good luck regulating a bot that trades in milliseconds.
Right. But the true bottleneck for AI right now isn't just efficiency or rogue trading bots. It is what the sources call the agentic payments gap.
Okay, so this is the idea of an AI agent acting like a personal assistant that actually has the power to buy things for you,
Exactly.
like booking a flight or paying a software subscription on your behalf. Everyone is excited about it, but the adoption just isn't there.
The supply side is more than ready. I mean, Stripe supports payment protocols across 5 million businesses, but almost no one is actually using AI agents to make daily payments.
So if you are listening to this and thinking, why would I ever want an AI bot making payments for me? You aren't alone. Why is there such a massive lag? Like, if Stripe has the rails built, what is stopping my AI from buying me a coffee?
It is entirely about structural friction. First, users just haven't connected their actual funds to these agents because of security fears.
Which is totally fair.
Very fair. Second, there is the harness layer. Think about who controls the environment the AI lives in.
Okay.
If your AI agent lives on your iPhone, Apple's iOS dictates what it can and cannot do. If the operating system doesn't seamlessly allow the agent to interface with your digital wallet, the transaction fails.
Okay, so it's like Stripe just built a massive multi-lane superhighway, but we're all still sitting in our driveways because our smartphone's operating system doesn't know how to turn the car on.
That is a perfect way to look at it. And the final piece of friction is the legacy billing architecture itself. Merchants are used to a human pulling out a credit card for a monthly subscription. AI agents operate on microtransactions, paying fractions of a cent per second of compute power. Migrating a merchant's entire backend from a monthly subscription model to a continuous usage-based model is incredibly difficult.
So are we just stuck waiting for Apple and local coffee shops to overhaul their entire systems? Or is there a fix in the works?
Well, the plumbing is actively being upgraded. The sources highlight several massive tailwinds, specifically things like Base's Agent Kit, open source agent frameworks like OpenClaw, and a protocol upgrade called EIP 7702.
Let's break down EIP 7702 because that sounds like pure alphabet soup. What does that actually do?
Think of EIP 7702 like giving a valet key to your digital wallet.
A valet key? Okay.
Yeah, normally giving an AI access to your wallet is like giving it the master key to your house. It's terrifying. EIP 7702 allows you to mathematically authorize an AI to spend exactly $5 on your behalf. And after 1 hour, that authorization mathematically self-destructs. You never hand over the master key. This concept, known as session-scoped wallet authority, completely changes the risk profile and collapses the cost of running agents at scale.
That is huge. So if these AI payments are currently bogged down by Apple's OS and Stripe's legacy billing, how is global value actually moving today? Because clearly, people in the real world aren't just waiting around for the tech infrastructure to catch up.
They aren't. And this brings us to perhaps the most significant structural shift happening right now.
The explosion of stablecoins.
Exactly, especially in emerging markets.
Yeah, this is where the narrative shifts from future tech hype to present-day reality. We are seeing platforms completely bypass traditional banking rails. What are the numbers showing us here?
The growth is staggering. You have a company like Flex Global that just crossed $9.1 billion in annualized payment volume.
And they've only been around for, what, 5 years?
Less than 5 years. They are expanding to over 170 countries, offering native stablecoin support for digital dollars like USDC and USDT across multiple blockchains.
They are even issuing Visa cards that let you swipe and spend your stablecoin balance directly at a grocery store, which is wild. Plus, they're launching a service called Flex Elite for founders' personal banking.
Which is brilliant because it abstracts away the blockchain entirely for the end user. And they're competing directly with platforms like RedoPay, which is currently dominating the 2026 crypto neobank rankings.
With nearly 1 million active addresses and almost 6 billion in tracked volume, according to the sources.
Right.
I am curious, though, why are these specific neobanks exploding right now? Like, if I'm a merchant or a user, why wouldn't I just use a legacy app I already trust?
It is entirely about where this growth is happening. If you are in the US or Europe, legacy apps work fine. But RedoPay is specifically targeting emerging markets in Latin America, Africa, and Southeast Asia.
Ah, the places with actual banking friction.
Exactly. Imagine you live in a country with a rapidly devaluing local currency and highly restrictive banking infrastructure. You want to hold US dollars to protect your purchasing power, but your local bank makes that incredibly difficult or charges exorbitant foreign exchange fees.
Right, so you use a crypto neobank to hold digital dollar stablecoins and bypass the local friction entirely.
Exactly. And it is not just US dollar stablecoins anymore. The sources note that on the Layer 2 network base, weekly transacting addresses for non-USD stablecoins went from near 0 to 25,000 recently.
Wow.
Driven entirely by adoption in these exact regions.
Okay. But we also have platforms like EtherFi Cash mentioned in the sources. They seem to be doing something totally different from the emerging market strategy.
Yeah, they are targeting a completely different niche, high net worth DeFi users.
Okay.
So instead of cashing out their crypto and triggering a massive taxable event, these users want to borrow against their yield generating assets and spend that borrowed money on a physical card.
So you have all these distinct niches being served. But if we look at the stablecoin rails race broadly, the sources argue that distribution is what wins in the short term.
Oh, for sure.
Like the Visas, the MasterCards, the Stripes, they are embedding stablecoin functionality into their massive existing networks. If they fully flip the switch, aren't they just going to crush these specialized crypto neobanks?
In the short term, distribution incumbents definitely have the upper hand. But specific user needs, like escaping local currency devaluation, currently protect these specialized niches. Legacy giants historically ignored those markets because they were too complex or unprofitable to serve with traditional rails.
And long term.
Long term, the real winners are the infrastructure providers, companies like Circle, which issues USDC. They capture the durable value as the underlying settlement layer compounds its network effects over time. That is exactly why the total stablecoin market has skyrocketed from $4 billion in 2020 to roughly $320 billion today.
But the legacy giants aren't just going to sit back and watch $320 billion bypass their entire system. Which brings us to the counteroffensive.
Right.
The traditional megabanks are building their own highly regulated blockchain infrastructure.
They essentially have no choice. It is an existential threat to their core business model.
The numbers in the sources really back that up. Estimates show that if this trend continues, stablecoins could drain 3 to 5% of core bank deposits over the next 5 years.
Yeah.
That would cut average bank earnings by roughly 3%. We are talking about billions of dollars in revenue just evaporating.
So their response is something called tokenized deposits. JP Morgan, Bank of America, Citigroup, Willera, they're all collaborating to build a shared tokenized deposit network through the clearinghouse, aiming for the first half of 2027.
Okay, let's make sure we clearly define this. How is a tokenized deposit issued by JP Morgan actually different from a stablecoin like USDC?
Yeah.
Aren't they both just digital dollars on a blockchain?
They both represent a dollar, but how they function is vastly different. A stablecoin is an open-loop instrument. It exists on any compatible digital wallet anywhere in the world instantly.
Right.
A tokenized deposit is a closed-loop instrument. It is trapped strictly within the issuing bank's walls or within the consortium of banks that agree to recognize it.
Oh, I see. Like tokenized deposits only work between the big banks.
Exactly. They are heavily audited, they attract yield, and they can handle virtually unlimited volume without clogging a public blockchain. This makes them absolutely perfect for a massive multinational corporation that just needs to park $1 billion overnight and earn interest. But they cannot leave that banking network.
So it's like casino chips.
Okay, yeah.
If I am inside the Bellagio, those chips represent real money. They have immense utility at the blackjack tables. They're perfectly regulated by the house, and I can move millions of dollars around the floor instantly. But if I take those chips down the street to try and buy a coffee, they are completely useless.
That is a brilliant way to conceptualize it. The tokenized deposits are the casino chips, whereas stablecoins are the actual cash in your wallet. You can hand that cash to anyone, anywhere, without needing the casino's permission.
That makes perfect sense. And the sources point out that these two instruments are actually complementary, not competitive. Banks like Standard Chartered, SoFi, and Coastal Community Bank are already using stablecoins for cross-border cost reduction. They use the open-loop cash system when it benefits them.
And regulators are starting to formalize this dynamic. The sources mention the recent passage of the Genius Act in the U.S., which is shaping this exact three-way competition among stablecoins, tokenized deposits, and tokenized money market funds for institutional money.
And meanwhile, over in Europe, entities like Zodiac Custody just secured a CSSF license in Luxembourg.
Yes.
Let's translate that. What does securing that specific license actually allow them to do?
It adds payment capability to their European operations under the MiCA framework, which is Europe's comprehensive crypto regulation. Basically, it allows a regulated institution to legally receive, hold, and transmit stablecoin value across the entire European Union, passporting across member states. The regulatory walls are officially being built around this technology.
Which means we are talking about a massive permanent migration of capital.
Yeah.
Trillions of dollars from megabanks and crypto neobanks moving on to underlying blockchain code.
Mind-boggling amount of money.
Right. And if that is the case, the security of that code isn't just a technical issue, it is a systemic existential requirement.
And to understand the stakes, the sources provide a really chilling example of what happens when that security fails.
Right, the Zcash situation. Shielded Labs recently disclosed a massive counterfeiting vulnerability in Zcash's Orchard privacy pool.
Yeah.
And the terrifying part, this bug sat completely undetected since 2022.
Yeah.
For 4 years, attackers theoretically could have minted unlimited fake ZEC tokens or drained funds from the shielded pool. Naturally, when the news broke, the price tanked.
But look at what happened next. The price rebounded 45% upon the announcement of the Ironwood upgrade.
I am looking at the notes on Ironwood, and I just have to ask, if a catastrophic bug in a major billion-dollar network can hide in plain sight for 4 entire years, how can you confidently tell me we should be running global banking infrastructure on this tech?
Look, if you are listening to this and feeling skeptical, you are having the exact same reaction as institutional risk managers. But the reason the price rebounded, the reason the tech is actually maturing, is how the system recovers.
Explain the recovery mechanism. What did Ironwood actually do to fix the problem?
In the legacy financial system, if someone counterfeits physical money, you have to rely on a central authority like the government or a central bank to catch it, absorb the loss, and manually fix the ledgers. The Ironwood upgrade was a joint proposal to create a brand new corrected privacy pool. But more importantly, it mathematically blocks the old compromised pool. It forces any counterfeit tokens to either be exposed when they try to exit the system, or they are permanently stranded and destroyed.
So it mathematically cordons off the bad code without needing a central bank to step in.
Exactly. It restores supply auditability without requiring users to just blindly trust the developers. And this is exactly why we are seeing leaders like Vitalik Buterin pushing hard for something called formal verification.
Which is what exactly?
Historically, developers write code and then run tests to see if they can find bugs. Formal verification is the practice of mathematically proving that a smart contract will behave exactly as intended under all possible conditions against a strict specification.
Oh, wow.
It is the evolution from, we tested our code and hope it works, to we can mathematically prove our code is bulletproof. It is an absolute necessity for the trillion-dollar era.
It really is a crucible. So, to recap the journey we have been on today, we started with the harsh reality of the macro market. where leveraged traders are forcing billions in liquidations, and pure narrative is just dead.
Very dead.
We explored the immense friction of integrating AI agents into legacy operating systems, despite the massive potential of upgrades like EIP 7702. We looked at the real-world explosion of stablecoins solving actual currency problems in emerging markets today.
Yeah.
And we broke down the massive defensive moves by traditional banks building tokenized deposits, the casino chips, to stop the bleeding.
It is a complete rewiring of how value moves globally, and we are literally watching the new plumbing being installed in real time.
But before we go, consider this detail buried in our sources, something we haven't even touched on yet.
Oh, I know what you're going to say.
Yeah. Well, the mega banks like JP Morgan and Bank of America are building their massive network through the clearinghouse. U.S. regional banks are quietly building their own competing tokenized deposit platform.
Right.
It's called the Kajari network, and they're building it on a blockchain called Zcash. So what happens if the future of money isn't just traditional banking versus crypto, but a fragmented technological civil war between the mega banks and the regional banks, all running on competing blockchains?
It definitely changes how you look at the surface level noise we talked about at the beginning, doesn't it?
Absolutely. Thank you for joining us for this deep dive. Keep asking questions, keep connecting the dots, and we'll see you next time.
Spoken Tech for your ears.